The price on your screen is a fiction. It is a digital ghost, a number generated in a world of promises and pixels. But right now, that ghost is being chased by a physical reality, a reality of empty shelves, silent phones, and industrial machines that cannot run on promises. The entire system is experiencing a kind of financial schizophrenia, where the paper price and the physical price are living in two different worlds. And in the coming days, one of those worlds is about to impose its will on the other. This is not a prediction. It is an observation of mechanics. The mathematics of supply, the psychology of fear, and the cold, hard data from locked vaults are all converging on a single, unavoidable point. A rupture is coming, and when it arrives, the shock will be felt by everyone from the pensioner to the central banker. The official action, the one that matters, is not an announcement. It is a silence. It is the absence of a phone call. For decades, the silver market had a built-in safety valve. It was the secondary supply, the recycled silver. When the price rose high enough, the phones would ring in refineries and scrap yards across the world. People would bring in old jewelry, silverware, industrial scrap. This flow of metal from drawers and attics back into the market would cool the price down. It was a constant, reliable source of supply. That phone has stopped ringing. Industry reports from major refiners in Switzerland and North America confirm it. The flow of scrap silver has dried up to a trickle. This is a behavioral shift of monumental importance. It means the public is not selling, they are holding, or they are buying. When people refuse to exchange a tangible asset for a digital currency, even at a higher price, they are sending a signal. They are voting with their silence. They are saying they trust the metal in their hand more than the number in their bank account. This is not a market signal, it is a social one, and it removes the most flexible source of supply from the equation. At the same time, the official demand numbers tell a story of relentless pressure. The Silver Institute's data shows a structural deficit for 3 consecutive years. In 2024, that deficit was approximately 200 million ounces. That shortfall was met by draining above-ground inventories, but you cannot drain a bathtub forever. The level is getting dangerously low. This brings us to the stark contrast between the paper market and the physical market. They are two different universes operating under different rules. The paper market is the world of the COMEX, the London Bullion market, and the SLV ETF. It is a world of futures contracts, options, and derivatives. In this world, silver is a financial instrument. It is traded by algorithms and hedge funds. Most trades are settled in cash, with no metal ever changing hands. The price here is set by sentiment, leverage, and the constant battle between buyers and sellers of promises. It can be influenced, some would say manipulated, by large players with specific goals. The physical market is a different beast. It is the world of the industrial user, the solar panel manufacturer who needs silver paste to make a photovoltaic cell work, the electronics company that needs it for 1 million switches, the jeweler who needs it for a necklace. For them, silver is not a trading slip. It is a raw material. They cannot run their factories on a futures contract. They need the actual metal, and they are increasingly worried they will not get it. This has led to a radical change in behavior. Major industrial consumers, like those in the solar and electric vehicle sectors, are no longer just buying on the exchanges. They are going directly to the mines. They are signing long-term supply agreements, bypassing the traditional market entirely. They are building their own private stockpiles. This is an unprecedented move. It is a vote of no confidence in the ability of the paper market to deliver the goods. Every ounce they lock up in a private warehouse is an ounce removed from the available liquidity in the public market. This makes the paper market thinner, more fragile, and more prone to violent swings. So we have a situation where the paper price might hover around a level like $90, but the physical buyer, the one who actually needs the stuff, is paying a significant premium to secure real metal. 2 prices for the same thing. This cannot last. In a crisis of confidence, the physical price always becomes the real price. The evidence for this crisis is found in the vaults. The inventory data is the heartbeat of the physical market, and its rhythm is growing weak and erratic. The COMEX, the New York Futures Exchange, reports its warehouse stocks weekly. There are 2 categories, registered and eligible. Registered silver is the metal that is cleared and ready to be delivered to settle a futures contract. It is the working inventory of the exchange. Eligible silver is metal stored there, but not pledged for delivery. It is essentially off the market. The number that matters is registered, and that number has been in a persistent, steep decline, from over 120 million ounces a few years ago to recently dipping below 30 million ounces. This is the metal that backs the promises. When a trader stands for delivery on a futures contract, this is the pile it comes from. At the same time, the number of open futures contracts, representing the promises to buy or sell, remains staggeringly high. The ratio of deliverable metal to open obligations has reached extreme levels not seen in decades. This is a simple mathematical problem. If too many people ask for delivery at once, there is not enough metal in the registered category to go around. The London Bullion Market Association, the other great hub, shows similar strains. Reports of large withdrawals and falling total inventories are consistent. This is not speculative froth. This is measurable depletion. It is the slow-motion evacuation of metal from the heart of the financial system. Furthermore, the behavior around monthly futures contract expiry is changing. The percentage of contracts where the buyer insists on taking physical delivery rather than settling in cash has been rising. This is a critical signal. It means more participants, often commercial users, want the real thing, not the cash equivalent. They are signaling a preference for metal over dollars. When this happens in size, it stresses the delivery mechanism of the exchange itself. The system is designed for cash settlement. It is not designed for a mass exodus into physical metal. The motives of the large banks and institutions in this setup are not mysterious. They are rational and predictable, governed by profit, loss, and survival. Many of these institutions are what the market calls commercial shorts on the COMEX. This means they have sold silver futures contracts, betting the price will go down. Their reasons are complex. Sometimes it is to hedge physical production. Sometimes it is a pure speculative bet. Sometimes it is part of a broader market-making operation. The Commitment of Traders report published by regulators shows these positions. They are large, they are persistent, and they are now underwater as the price has moved against them. For these entities, this is a risk management problem. A loss on paper is one thing. A catastrophic loss that threatens the institution is another. Their primary motive is to manage that loss. They have a few tools. They can try to push the price back down by selling more paper contracts, adding to their short position in a dangerous game of doubling down. They can do nothing and hope the price retreats. Or they can close their positions by buying back the contracts they sold. This is called covering. But covering a short position of hundreds of millions of ounces is not like buying a stock. It is a massive undertaking. Buying that much, even in the paper market, creates enormous upward pressure on the price. The act of covering can cause the very price spike they fear. So they are trapped. Their motive is not to cause a squeeze. Their motive is to avoid being squeezed. But in trying to avoid it, their collective actions can become the very trigger for it. They operate within the rules, but the rules of a leveraged paper market break down when they collide with the physical reality of empty vaults. The psychology of the retail investor in this environment is fraught with danger and emotion. For years, the narrative around silver has been one of frustration, the poor man's gold that never seemed to perform. Investors have watched it lag, seen it be volatile, and many have grown tired. They have been conditioned by a market where stocks only go up, where central banks fix every problem. This creates a powerful and dangerous mindset, impatience. When silver finally begins to move, after years of dormancy, the initial reaction from many will be skepticism. It's a fake-out. It will be slammed down again. This is the trauma of past disappointments. Then, if the price rises further, psychology shifts to FOMO, fear of missing out. But this FOMO is tinged with anxiety. They buy, but nervously. They watch every tick. Then comes the volatility. Silver is known for its sharp, violent pullbacks. A 10% drop in a day is common. This is where the psychology breaks. The inexperienced investor, driven by FOMO, buys near a peak. The sharp pullback then triggers panic. They see a loss on paper and their mind screams, "It's happening again, it's a trap." They sell at the bottom, cementing a loss. This cycle feeds the very volatility that hurts them. The professional, the physical holder who has no margin debt, simply watches. They understand that in a true physical shortage, paper market volatility is just noise, but the retail mind is not wired for this. It is wired for instant gratification and a clear narrative. The coming period will present no clear narrative, only chaos. It will be a war between paper volatility and physical scarcity. The retail investor, staring at a screen of flashing red and green numbers, will be a soldier in that war, often fighting on the wrong side because they are reacting to the paper world's tricks, while the real battle is being fought in the physical world's vaults. Based on these converging lines of evidence, the silent phones, the inventory drain, the institutional trap, and the volatile public psyche, we can observe several potential scenarios unfold. None involve advice, only a mapping of possibility. In one scenario, the pressure builds slowly. The paper market continues its volatile dance with sharp ups and downs, but each low is higher than the last. The physical premium continues to rise. Industrial users successfully secure their private supplies. The exchanges manage to avoid a default by using cash settlements at higher and higher premiums, which gradually pulls the official paper price upward to meet the physical reality. The move to a price like $150 is orderly, if volatile, over a period of weeks or months. The system absorbs the shock, though some banks report significant losses. In a second, more abrupt scenario, a catalyst triggers a panic. It could be a major industrial player announcing they cannot secure supply. It could be a report showing COMEX registered inventories falling below a critical psychological level. It could be a failure of a large short entity to meet a margin call. This sparks a rush for the exit in the paper market. The algorithms, detecting a momentum breakout and failing liquidity, flip to buy and accelerate the move. The price gaps higher dramatically, bypassing many price levels as sell orders vanish. The exchange may intervene, raising margin requirements to staggering levels, freezing out smaller players and trying to force liquidation. This creates a violent spike, potentially reaching or surpassing the $150 level in a matter of days, followed by an equally violent collapse as leverage is purged. But the physical price, in this scenario, may not collapse as far, establishing a new, much higher floor. A third scenario involves direct intervention. The strain becomes so public and so threatening to financial stability that behind-the-scenes coordination occurs. Central banks or treasury departments might lend metal to the exchanges to meet delivery demands. Regulatory announcements might be made to change the rules of the game, perhaps limiting who can take delivery or redefining what constitutes a deliverable contract. The price is suppressed through sheer force of will and political power. This would be a temporary dam, but the water of physical demand would continue to rise behind it. The fundamental deficit would remain. This scenario would lead to a prolonged period of frustration for bulls, but would also store even greater potential energy for a future, more explosive move. The final tail risk scenario is a fracture. A major exchange fails to deliver and announces a force majeure, suspending physical settlement. This breaks the trust in the entire paper pricing mechanism. The link between paper and physical severs completely. The physical market would then trade at a price discovered independently in private transactions, likely at a massive premium to whatever the frozen paper price says. The paper market would become irrelevant for a time, a ghost market pricing a ghost asset. This would represent a crisis of confidence not just in silver, but in the entire commodity futures complex. These are the paths visible from the data: the silence of the scrap market, the echoing emptiness of the vaults, the calculated desperation of the shorts, and the emotional pendulum of the public. They are all pieces on the board, moving according to their own logic. The game is in play. The outcome is not certain, but the forces in motion are now visible, measurable, and real. The only fiction left is the belief that the number on the screen is the final truth. The game, however, is no longer confined to the board. The pieces have begun to move of their own accord, influenced by a force more powerful than any trader or algorithm: arithmetic. When you subtract a constant and growing demand from a shrinking and inelastic supply, the result is not a complex theory. It is a simple, unforgiving number. That number is the point of collision, and all the pathways we observe lead to that same collision point, differing only in speed and sound, the slow grind, the violent spike, the suppressed tension. They are just variations in the waveform of the same seismic event. The fault line is the disconnect between what is promised on a ledger and what exists in a vault. The earthquake is the moment the ledger is forced to reconcile with the vault. Let us examine this arithmetic more closely. The annual mine supply of silver is roughly 800 million ounces. It does not fluctuate wildly. Opening a new mine is a decade-long endeavor. This supply is famously inelastic. It cannot quickly ramp up to meet a surge in demand. Against this, we place demand. Industrial demand, which consumes over 50% of annual supply, is growing at a mid-single-digit percentage each year, driven by solar, electronics, and electric vehicles. Investment demand, the desire to hold silver as an asset, is a wild card, but it is currently absorbing the remaining supply after industry takes its share. Then there is the government mandate factor. Nations have legally committed to a green energy transition. That is not a market suggestion. It is a legislative demand for silver-intensive technology. This creates what economists call a derived demand that is immune to price in the short term. A solar panel maker cannot decide to use less silver per cell next week if the price rises. The chemistry is fixed. They must buy or halt production. This injects a frightening rigidity into the demand side of the equation, so we have rigid demand meeting inelastic supply. In any normal market, price is the valve that balances the two. But when the price valve is influenced by a massive paper market that can create synthetic, unlimited supply through futures contracts, the true balancing mechanism is broken. The paper market says, there is plenty. The physical arithmetic whispers, there is not. This whisper is getting louder. Now consider the role of time. The market exists in a constant present, but it is hurtling toward a fixed future. That future is the monthly expiry of futures contracts. Each expiry is a settlement date, a moment of truth where promises can be converted into metal. As the inventory buffer shrinks, each successive expiry date becomes more dangerous. It is like a game of musical chairs where 2 chairs are removed after each round. The music is the trading between expiry dates. The moment the music stops, the expiry, everyone looks for a chair. The chairs are the bars of registered silver. With fewer chairs each month, the probability that someone is left standing increases exponentially. The market participants know this. The industrial users know they need a chair to keep their factories running. This knowledge changes their behavior today. They will not wait for the music to stop. They will secure a chair early. They will stand for delivery well before a crisis is apparent to ensure they have metal. This prudent action by one player, when replicated by many, itself triggers the crisis it seeks to avoid. It is a self-fulfilling prophecy of shortage. The data from recent delivery months shows this beginning to happen. The trend is your friend until it ends. In this case, the trend of rising physical settlement is just beginning, and its friend is volatility. Within this environment, the banks and funds are not monolithic. They are an ecosystem with competing interests. The commercial shorts, often the banks, have one set of problems. The managed money, the hedge funds, and algorithmic traders have another. The commitment of traders reports show a stark picture. The commercials are heavily short, while the managed money are increasingly long. This is a classic standoff. It is the old guard versus the new, the physical hedgers versus the financial speculators. But to call it a simple battle is to miss the nuance. Many of these entities are intertwined. A bank may have a short paper position, while its wealth management arm advises clients to buy physical metal. A hedge fund might be long silver futures, but also short the shares of mining companies. Their motives are not aligned, but their actions are all reactions to the same magnetic pull of the data. The short wants the price to go down to survive. The long wants it to go up to profit. But both are watching the same inventory reports. Both are aware of the same deficit figures. This creates a tense, unstable equilibrium. It is a room full of people who all smell smoke, but no one wants to be the first to shout fire and cause a stampede that might crush them. So they edge toward the door, slowly, trying not to make a sound. But the door is narrow, and it only lets through so many at a time. The through line in all these stories is the physical object, the bar, the grain, the thing itself. In the orderly path, it gains value slowly. In the spike, it gains value rapidly. In the suppression, it becomes a hidden treasure, its value obscured but real. In the fracture, it becomes the only thing of value as the paper claim against it is voided. The variable is not the metal's value. The variable is the visibility and acknowledgement of that value by the broader financial system. The data from the vaults, the silence of the scrap dealers, the desperate moves of industrial users, they are all just different forms of the same message. The object is scarce. The system built on the promise of the object is now straining under the weight of that scarcity. The coming days and weeks are not about forecasts of $150. They are about observing the resolution of a fundamental imbalance. Will the system successfully manage the scarcity through price, or will the scarcity break the system? That is the only question that matters. The answer will not be found in a prediction. It will be found in the next inventory report, the next delivery notice, the next desperate bid from a manufacturer who just needs the metal to keep the lights on. The clock ticks to the rhythm of quarterly reports and monthly expiries. The arithmetic does not care about our hopes or fears. It only cares about the balance between what is needed and what is left.